But let's move on from the oil and gas space to housing finance. Home loans are likely to get cheaper as the Reserve Bank of India has obviously cut provision requirements and risk weights associated with higher ticket size loans. How does this impact housing finance, the entire space overall, in terms of credit offtake, and a company like Indiabulls Housing Finance in context of the premium category housing loans and cost of lending as well? To discuss this in further detail, joining us on the show is Mr. Ashwini Kumar Hooda, Deputy Managing Director at Indiabulls Housing Finance. Mr. Hooda, good to have you on the show. Good morning. Thank you for joining us. You've reduced your rates by 15 basis points recently. Is it at 8.35 right now?
Yes, so our prime lending rate for housing loans is 8.35%, and our rate of interest has always been in line with the best rate that is available in the housing market, as we target only the prime segment within the housing loan.
Right. Mr. Hooda, also tell us about what's happening as far as the cost side is concerned, because now possibly the RBI has left the door ajar for one more rate cut, or maybe if things look good on the inflation side, two more rate cuts. So is there more scope for transmission as far as rates further from here on are concerned? Because pretty much this recent bout of cuts that we've had has matched the industry with SBI and Bank of Baroda all have kind of aligned close to that 8.3% rate. So for the housing finance category, do you think there is further room for easing now, and possibly if the RBI comes up with another rate cut, probably by August?
Absolutely. So there is room for rate cuts, and we are very confident that by August we should see at least one rate cut, and over the entire financial year we may see two rate cuts. So I'm very hopeful that interest rates are only going down from where we are, and that is very good news for home buyers, as their interest rate on home loans also will come down. But more importantly, the effective cost of an entry level house, somebody buying a property of 40-50 lakhs or lower, is anyway a very low number because of Prime Minister's subsidy scheme and the tax benefit on a housing loan. So if you take a case of a person buying 35 lakh of property and taking 25 lakh rupees of loan, the effective cost today only works out to be 0.3%. So it's as low as that, where it is lower than the rental yield in the country at 3%. So your EMI check is actually lower than your rent check. That's a big game changer, as more and more people staying on rent will be now moving to their own houses. And in the affordable end of the segment, which is properties up to value of 40-50 lakh rupees, we are seeing a huge growth already happening in the country.
Oh yes, that kind of benefit has really played out from the consumer standpoint of things, as far as the mismatch and the correction between the EMIs as well as the rents are concerned. So that's also one positive trend that is skewing demand in favor of housing finance loans. But Mr. Hooda, let's speak about your borrowing profile now. Now the management is progressively moving towards a reduced reliance as far as bank borrowings go. By 2020, you have a target of 20 to 25%. Right now, what's that number? Is it close to around 37%? And what has been that incremental number? How does the borrowing profile look like? Any securitization plans as well that you have?
Absolutely. So liabilities has been the biggest strength of the company, and we have one of the strongest rating upgrades on our credit rating, which is allowing us to tap bond market. Recently, 2 weeks back, we got upgraded by ICRA to AAA. It is after 20 years that a rating agency has upgraded a non-bank finance company to AAA on a standalone basis, that is without any parental support. So clearly our bond program has done very well in the recent past due to our rating upgrades and the focus of government to make available more funding options to housing finance. Last year, 90% of our borrowing came from money market, bond market instrument, and less than 5% of our funding came from the bank term loans. So the focus of the company is, while to grow at between 25 and 30%, but to increase its reliance on the bond market which is way cheaper than the the term loan market from banks. Over a long period of time, typically bonds are almost 1% cheaper than term loans from banks, and that is helping company to save on the cost, as the composition of bonds, which is currently 52%, go up to 65% over next 3 years, while the balance sheet will double from here. Currently it is more than 1 lakh crore, it will go past 2 lakh crore, but it will be largely funded by the bond, and that should make our cost one of the most competitive in the market.
Mr. Hooda, let's also speak about the recent move by the RBI that has soothed a lot of nerves as far as companies like yours are concerned, especially for the higher premium category, because that was seeing very little traction. So what do you have to say about the risk weights that have been reduced and also the provisioning requirements? So you'll have to allocate lesser amount of capital. But do you see credit offtake happening in the 35 lakh and above and the 75 lakh and above baskets?
So clearly bringing down risk weight allows lenders like us to give out more loans for the same capital, and that is helpful, and we have reduced interest rate on higher ticket side loans by 10 basis point. More importantly, the commentary of RBI that these are counter cyclical measure, which tells us that the industry is at a very stable or a lower phase in the real estate cycle, and typically a real estate cycle is 10 to 15 years. So if we are at the bottom of a real estate cycle, and RBI is very smart on these things, then what it means is for next 5-7 years there could be very good growth without any risk coming into this market. So we are very encouraged by this view of RBI, and we believe while growth is strong in the housing market, the premium market should also start picking up, let's say over next 12-18 months. And then it will keep growing at a decent pace for next 5-7 years without any risk. World over, the biggest risk which is plaguing the central banks is the rise in housing properties, whereas India is unique, where house properties have been relatively stable or they've come down slightly in various markets, and that's very positive for India as we begin our growth journey from here on.
Right, Mr. Hooda, we're going to leave it at that. Thank you so much for joining us, taking us through the impact that the RBI's recent tweaking of risk weights will have on the higher premium category, and what you feel about prospects going ahead with the possibility of another rate cut that could come through by August possibly. So that was Indiabulls Housing Finance and the management for you. But let's now put the focus on oil marketing companies and the oil and gas space, especially focusing on the downstream end. OMCs to revise fuel prices daily.